Ladies and gentlemen, good morning. Good morning and welcome to this, which is the second webinar on sustainable waterborne infrastructure projects and green funding. We had a first webinar on this topic about 3 weeks ago, and this is IADC's second webinar on it. Both of these webinars are propedeutic to the conference which is going to take place in Dubai on the 9th of February, which will address this topic from a broader perspective. Today, we are going to have a talk about how to get these two worlds, the world of institutional finance and the world of infrastructure projects in watery environments together, with Paolo Alemanni and Christian Bertli. You can see our two guests on screen. I'll briefly introduce them, and then afterwards we will have a long talk for about an hour together with, we hope, some initial ideas of what the main obstacles are and how to overcome these obstacles in the course of the near future with regard to the funding of large-scale infrastructure projects in water-rich environment. Paolo Alemanni works with B Capital Partners in Switzerland, and he is an institutional investor. Paolo, is that right? Is that a proper way of designating you? Your microphone is still on mute.
Sorry.
There you are.
Hi, everybody. Thanks for joining the webinar. Indeed, we are helping institutional investors investing in the infrastructure space, including this. So I'm not directly an investor.
Okay, but you say you are helping investors.
Yes.
What does that help exactly consist of?
Well, we provide investment products. That means infrastructure funds, closed-end funds, or we help large institutions to directly purchase and acquire on their balance sheets infrastructure assets.
Okay, thank you. So for the people who join us from the dredging industry, that is the world you need to try and get in touch with. And for all the green capital which is available on the capital markets, those are the people who would need to understand how to get in touch with good investment opportunities in the world of dredging and similar infrastructure projects. Our second guest is Christian Bertli of Swiss Re, a reinsurance company. Again, Christian, for the financial people in the audience today, that will be very clear what it is that you do. But maybe for the people who have more of an engineering background, it would be good to explain what Swiss Re does exactly.
Yeah, thank you, Mike, and good morning, good afternoon to everybody. Swiss Re is one of the two largest reinsurance companies in the world. The other one is Munich Re. So we are, in essence, the lender of last resort. Whenever a big event happens, be it a hurricane, be it an earthquake, be it some flood, fires, Swiss Re and other reinsurance are actually there to fund the bill and make whole for the losses that either projects, individuals, or assets might have. So we are a insurance or a reinsurance company, as the name Swiss Re says. So we actually insure insurance companies, but we also provide direct insurance, especially for large projects, such as dredging projects. So we actually de-risk those projects to make them more bankable. That's for the build phase, if you want. However, once these projects are actually up and running, we also provide operational and maintenance insurance. So whenever something goes wrong, and that's an event that can be insured, then we are here to step in and provide the money so that it can be repaired.
Right. So in this case, you say an event that can be insured. So you make a distinction between events that can and events that cannot be insured.
Absolutely.
What does it relate to the funding of projects?
Well, we always hear that there are not enough bankable projects in the world. And when we speak about bankability, I mean, they have various aspects. For instance, on the insurance side, when we look at some projects, it depends, do we understand the technology involved? Do we understand the risks that are involved with this, for instance, dredging projects? And if you understand those risks, and if you can put a price tag on those risks so that we can actually assume those risks and things in case things go wrong, then these are insurable. However, for instance, they are uninsurable risk, for instance, entrepreneurial risk, or the risk that the project owner actually should carry. And it's always I would say it's probably up to discussion on how much we can stretch the boundary of insurance, but it's very much a discussion when we look at project, which party actually assumes which risk in the project, which risks can be mitigated, which risks have to be absorbed by the equity, and which risks then can be transferred to insurers or also financial institutions, for instance, currency risks and other risks that then can be hedged. I think it's very much the whole spectrum. I think it's not the right or wrong answer. It's really a discussion of what is feasible and what is doable.
Okay, thank you for providing that background. Now, in order to have a bit of background of our audience as well, I'd like to launch 2 quick poll questions, ladies and gentlemen, to you. If all is well, they should appear as a pop-up in your screen and you can answer. For some versions of Teams, they will appear in the chat box, and then you can type up your answer in the chat box, or you can make your selection in the chat box. So the first poll question is to have an idea about your background. Where do you come from? Are you from the dredging industry? Are you a potential client of dredging or infrastructure services? Are you a government representative? Are you a representative of financial institutions? Just quickly choose which one of these you are, and we will have an idea of our audience population. I'll give you a couple of seconds to do that. And then once we have those insights, right, that's done. Very good. Thank you. So very clearly, we have a majority of people working for financial institutions. And I'm sorry, ladies and gentlemen, I'm not looking at the screen because I'm reading this off from my phone, and of the dredging companies, and then a couple of people from NGOs and public entities. So we're mainly focusing on those 2 groups, a couple of people from financial institutions and from dredging industries. And then the second poll question I'd like to submit to you before going back to our guests is, what is the main reason why you decided to attend this this seminar today, this webinar? So poll question number 2, what is essentially your main reason for joining us here today? And again, a couple of seconds for everybody to respond. Good, and we can see that as well now. For the majority of people, oh, sorry, not yet. Here we are. So the response is that most people is that they want to know more about projects having an attractive risk profile. So Paolo and Cristiana, maybe I better start with Paolo, especially for the people in the dredging industry. Can you give us a bit more background about how you propose a possible investment decision to some of your clients?
Sure. Thank you very much for the introduction. As I said, we help financial institutions and institutional investors in investing in the broad infrastructure space, which is mainly for investment size, the energy world, but also the public-private project environment, which is a way to reduce the risks In the last poll, we saw that many of the responders thinks that the right condition for PPP are not in place in this kind of specific projects. The scope of the study that we conducted together with Swiss Re and Vital Ports, and for the two largest association of the dredging industry, shows that there are ways and there are also examples and cases that are already in place where the risk mitigation and the let's say putting together financial lenders and financial investors for the equity part is possible alongside the public authorities commissioning the projects or the dredging industry supporting and sponsoring the projects. So I think that there is already examples of these possibilities. Clearly, the world of the sustainable maritime works is very large in terms of size, and not all the projects can be applicable for a cooperation between private funding and public funding. Ria, if you might show the slide, we can give some background that brings everybody on the same table, on the same page. This is a graph taken out of the report. It shows in the columns cash flows. That means money going in or going out from the project. The red or the pink part of the columns on the left hand side are the outgoing flows, which are the investment costs. So I have to pay for the dredging works, for the construction works, for the people working there, and so forth. So any single project has negative flows at the beginning. Going in operation, after having gone into operation, the project provides positive cash flows, which are the yellow bulks or the yellow columns on the right side. They might vary and they might come from different streams of cash or for different streams of contracts relations, and they will serve first of all the repayment of the loans. Secondly, first the operating costs, then the cost of financing, so the service of the finance, so the debt that has to be repaid, including the interest, and what is left is the let's say the cash flow available for the shareholders, for the investors that has put money into the project at the very beginning. So this is the normal way we in the financial world value projects. Clearly, what we do is an analysis of the sustainability of the cash flows going forward, I mean the positive ones, having deducted the cost and the cost of financing. The same applies to banks or lenders, which are doing the same approach in valuing and the bankability of a project. So what is relevant for us is to see if the project, being a large or a small one, doesn't make any difference, provides positive net present value, which means that given a certain cost of equity or cost of the risk of the project in comparison to what the financial market offers, the net present value is positive. That means that I'm making a gain out of this stream of cash flows in the future. So this is just to give you a first background of corporate finance 101. But very important for us is that we have to analyze the risk or the constraints connected to the project in this specific segment, which means who is giving us the yellow columns. So it's the government, is the market, is the increase in the possibility of the economy locally, which somehow the project might get back in terms of money. This is the very first problem that we see in PPPs. We have different methods and availability systems, which gives the connotation to the yellow bulks. So it might be the government or the authority or the local authorities or the local municipalities, wherever, the ministries paying on a availability base. That means there is a sort of rent for having the sponsors or the developers put the project in place. There are other systems which are more interesting, let's say so, which mix the public support, so the rent, let's say, with the economic and commercial incoming streams of cash. For instance, the use of the new infrastructure or the new laying gained by the renovation or by the project from renting the land or from getting money out of the agriculture that is possible on the land. So there are different ways to structure a project in this way. I would stop here before getting into too much detail, but please, any question if you would like.
Yeah. Well, of course, on the look of this makes sense. This is common sense. There's a number of costs, and the project needs to produce a reasonable cash flow, and therefore some kind of flows of money that come out of it, which is interesting for the investors. However, if you look at the actual situation in projects that are on the market, as Christian already indicated, there are often problems with these projects' so-called bankability. So what are some of the obstacles that we can easily identify from your viewpoint, from the viewpoint of investors, of the world of finance, around the maritime infrastructure projects? Christian, could you answer that first?
Well, we probably can spend the rest of the hour on that particular question, Mike, but I think I just want to...
I would also like to talk a bit about the solutions afterwards, but go ahead for about 20 minutes.
No, I just wanted to make a few main points. I mean, with those type of... Well, first of all, we, as well as Pablo and many others, we are commercial entities. So we have an obligation to our shareholders and to our policy holders as well to make sure that our investment generate a return which is justified for the risk we actually take. So the risk return profile has to be right. A second point I want to make, we also want to invest in the right projects, because Swiss Re, as many others, we actually signed up, for instance, to the Net Zero Asset Owner Alliance, Net Zero Insurance Alliance. So we are very cautious about the impact those projects have on ESG criteria and so on. So that's a very important element in considering investments. However, a lot of those projects, especially if we speak about PPP projects, very often they don't have a commercial return. So if you do a wind farm, it's obviously you have a return, you sell the electricity and all good, you make your math. However, if you build a dike that actually protects, let's say, a coastline or have flood protection in place, I mean, what you do, you actually avoid future losses. And then the question is actually, I mean, how do you factor that in? So if it's a project that's government supported, it's clear. I mean, instead of then having the bill to feed those losses, raising taxes or a bond, or going back to public end, they actually avoid those taxes and they can build these cash flows or this cash flows assumptions into the project. So that's one element. Sometimes these projects don't have really a return, but they actually provide a benefit.
But as an insurer or a reinsurer, what kind of advice would you give to Paulo's clients on avoiding future risks? And does that at the end of the day, does that become a political problem?
It could be a political problem, because ultimately, if you are a government or a municipality, I mean, the question is actually when and how do you spend money? I mean, especially now after COVID, I mean, a lot of public finances are actually drained. So the question is really, do you have now finances available, for instance, to build a dike, to build a coastal protection, to build flood protections, or not? And I mean, in the long term, we probably can argue that these investments actually pay off. But in the short term is the question actually who finances it? And then the question is, okay, if you have a PPP model with blended finance, do you actually have donors or multilaterals to come in who actually provide, let's say, grants or concession loans that are below market price, provide below market price access to money and so on. So it's a complicated discussion. I also want to make another point. I mean, sometimes you actually have positive externalities that come after a project. And one of the case studies we actually featured in the report is the Prince Hendrik dike. I like that very much because Swiss Re was actually insuring that dike for this new way to build it. I mean, it's basically a green solution instead of a grey solution.
Christian, just so that people have a bit of an idea of where is it and what does it do?
It's in the Netherlands and it protects the coastal line. And instead of pre-building a grey protection, coastal protection, parties actually decided to have a nature-based solution there. So it's a sand dune that has been constructed, which then blends automatically into the landscape. So what are the positive externalities? I mean, the positive externalities is that this region now attracts more than 1 million visitors each and every year. So, I mean, how do you factor that in? I mean, if somebody has a B&B or a coffee or something like that, I mean, ultimately these people probably then pay taxes, so it will flow back eventually, but it's not a direct return to the project. Also, I mean, if you go there and you use your bike or you walk your dog, I mean, there's a positive effect on your mental health or your well-being, on society in general, but how do you factor that one in? And I mean, these externalities are very often underestimated and not part of the cash flow consideration, which makes it actually sometimes difficult.
Yeah,
I think I'll stop here, but there are many things to consider. You know, maybe quickly from an insurance point of view, I would say it doesn't factor in that much, because ultimately what we insure is the construction of the project and afterwards the maintenance of the project. So, I mean, these considerations are probably more there for the private, for the PPP finance model, as well as for investors to consider, less probably from an insurance point of view.
So Paolo, listening to what Christian just said, is it an almost classical situation where you don't know enough about what's happening in the long term, and as a result, you go for projects which are more predictable and therefore have an easier identifiable risk profile in the short term?
Yes. Just a few. What are the requirements for an equity investor coming from the financial world into a very technical segments like this one? We are looking for long-term stream of cash. That means,
but in that respect, infrastructure projects are good, right? Because they provide.
Yes, exactly. So this is the first tick mark that we can check. The reality is that in order to have predictability over this long time frame and stream of cash, we need to have a sufficiently stable political situation, including a legal framework which provides for the possibility to invest and recover or repatriate the returns or the dividends from the project, which means, for instance, we need a clear legal framework which rules the PPP markets or the PPP projects in the specific country. This is something that is not new to anybody. I mean, in many jurisdictions, this is available, and more or less the systems are the same. There is a public procurement and some rules of having privates involved in public procurement. So it's not something out of the world, not at all. The reality probably is more related to the fact that investors like us have a specific restriction when they start a product. A product for us is the closed-end fund. So the infrastructure closed-end fund can say, or the investor investing in our products can say, I do not want to risk too much, therefore I'm not very open to investments in development countries, or vice versa. I do have, I'm looking for higher returns. Therefore, I would like you, fund manager, to invest in developing countries or in projects that are ready to build or even in the greenfield phase, so not yet operational. This very much depends on the allocation of the single investors. We are talking about an industry which is huge. I mean, the infrastructure fund management world is really large. There are funds which on a single fund, or fund manager, which on a single funds, they can raise 30 billion US dollar. So on a single fund, we, Big Capital, we are a very much smaller player in the market, but this doesn't make any difference. So the way we are considering the market is the same. So that means that there are, we have to look for the projects. Where is the jurisdiction? Is the framework locally available in order to be sure that we can invest equity? Yeah. But what Christian was saying is very, very important. First of all, any of our investors or clients are now mad about sustainability. In both sense, in the sense that they are looking to invest actively in projects that are making an impact. This is the first point. So they do want to have an impact on a positive impact on the decarbonization of the world, on the reduction of the climate change consequences. On the second hand, if you want to offer them a product which is sustainable, in Europe at least, we have a very strict regulation, which is called SFDR, which prevents us to say, you know, I'm greenwashing my portfolio by buying something that might be of impact. No, there are very strict requirements in order to say, yes, this is a product, financial product, closed-end funds, which is sustainable, which can say it's sustainable. So this is a positive fact and a negative one, because we have a lot of costs in order to control if there is something is sustainable, but that's the normality of business.
Yeah. So we already see that there's a number of potential obstacles which you've identified. Even though investment in green projects is interesting, we've heard there is a lack of a consistent legal framework in certain parts of the world, as a result of which the cash flows from those parts of the world would need to be higher to cover for the potential risk, right? The second one, we've heard there are potential beneficial outcomes, which you call positive externalities, Christian, which are very hard to gauge. A third one is the PPP framework often doesn't give you a lot of leeway, right? Can you say a bit more about that? Because you work a lot with PPPs, and PPPs are, I assume, one of the main instruments that is on the market in order to get projects financed. What are some of the shortcomings that create obstacles for the application of this instrument? Christian?
I will probably argue that whenever you look into projects, it has to be a joint screening, and I mean, many parties are normally involved in those projects. And if I come back to the insurance side.
Let me interrupt you there immediately. When you say joint screening, what do you mean exactly?
There are many stakeholders on the table. So you basically have the public entities who have a public interest to protect or preserve, or whatever you want to call it. You have the financiers, you have the EPC contractors involved, you potentially have insurers involved. Then if you have emerging markets, you might actually have special financiers involved. That means DFIs or multilateral development banks. You have credit export agencies involved. You might have specific jurisdiction. You might have to deal with land ownership. You might have to deal with permitting and so on. You have to understand the regulatory framework, the investment framework, and so on. So what I'm saying is this: sometimes they are very, very complex projects, and the earlier parties get involved, and the more a dialogue parties have, the more, I would argue, the higher are the chances of success in those projects. And also, then, if you look at, for instance, especially in emerging markets, I mean, the role, for instance, the development banks have there or even donors. I mean, we can't underestimate that. I mean, a lot of money goes into pre-feasibility studies or feasibility studies to actually provide the groundwork on what is doable, but also then the positive impact on the 17 ESG criteria of the UN. I mean, a lot of the risk sharing is something where multilaterals have a big impact with their guarantees they provide, as well as the concessional financing, so makes those projects a little bit more attractive for the finance companies. I mean, these are all considerations. I think we probably can't narrow it down on one or two topics, but it's a whole host of issues that need to be solved in this so-called, what I call joint screening or partnership agreement.
So to put it bluntly, it's much easier for any institution who needs to commission a big infrastructure project to say, just drop the concrete here. How much of it is it? Okay, good. Here's the bill. I'll pay. Rather than having all of these stakeholders getting on board. So what would be next steps in order to make that easier? Either of you, Cristiano, Paolo.
Well, in our experience, there is an history of positive examples in the PPP world, which started, very frankly, in an industrial way in the UK in the late 80s and 90s. The main takeaway is that by putting together the public authorities procuring the project with the technical or industrial partner, which is the one building the substance, I mean the asset, and the financial investors on both sides, I mean lenders and equity providers, is the right way to get transparency over the project in two ways mainly. One is to have a four eyes principle on the control of the costs and setting strict control over the overruns in terms of time overruns or cost overruns. No? So this is a very first positive aspects. The second one is that by putting together, as Christian says, the full spectrum of interested parties in a project, you might connect the technical project itself, I mean the planning of the project or the contents of the project with the capital structure required to finance it. So what we bring to the table is the capacity to understand what is the best mix, as Christian says, of different cost of equity or cost of capital. So there are multilaterals which are reducing the risk, so therefore the cost of equity for the most junior part, which is the equity investor, can be mutually together. So working together. That means that the most riskier part of the capital structure, the one that the equity providers provide to the project, is somehow reflected in its risk return by the presence of the other lenders or sponsors. This together with the fact that all the parties knows the project very well, so they know that the project will last 12 months, 24 months. That the cash flows, outgoing cash flows, I mean the investment cash flows, will be spread over the 24 months in that way, that all the permitting is in place. There is no risk that something is changing. That so and so forth. Yeah. But the most important part, as I said, for probably is the yellow bulk or the yellow columns in the cash flow. So there we need to understand how does the money come from the various sources. Very relevant in any case is to define with the public procurement agency what is the return. So if we agree with the lender and with the multilaterals and with the project construction company and with the public authority, that this project can fly only if it's like that, there is it's mathematics. I mean, it's not rocket science. It's just to have everybody involved and sure about the transparency and the requirements of the various parties. So putting together everybody again is the most interesting and most important part in this kind of projects.
Which means starting the project in a fundamentally different way, right? Which is talking first and then providing the specs, rather than immediately providing specs on the basis of only maybe a contact with a consultancy agency and then just putting that out to the market. Is that a fair way of summarizing what you said?
Or the consulting or the sponsors pushing for the project, they need to involve all the parties right at the beginning, which is the same. No?
Yeah. Okay, let's see if we're just over halfway, if there's already any questions from the audience. You can ask a question, ladies and gentlemen, simply by raising your hand, and then you can come on screen and open your mic, or you can type up a question if you want to in the chat box. Of course, we would prefer the first solution so that we have the pleasure of seeing you live in the webinar. So is there anybody who at this point would like, yes, I see a hand raised by a person called Jack Kirkland. Could you come on screen and switch on your microphone, please?
Yes, I did.
Hello, we can hear you.
Good. Well, thank you for the opportunity. Just to give you a little bit of background of what I'm doing. I've been in the dredging and reclamation industry for 45 years. I worked for one of the major dredging companies for more than 33 years. That's why I know Reinoud. And I'm now a consultant in the Australasian region, and for the past 11 years. One of my clients is the United Nations Development Program.
Yeah.
And we are at the moment executing one of the projects in the Pacific.
Right.
But there is a lot of...
Could you come to the question, please?
Yeah. The question is, there is still a lot more work to be done in respect of the coastal adaptation in the Pacific. So the question is who to approach, how can we get all the parties together to discuss all the future projects which still has to be done for the coastal adaptation in the Pacific.
Okay. Christian, do you have an idea who to turn to?
Well, I have a view that is actually based on what we do, i.e. as an insurer. So, I mean, I think if you take a step back, I would say you probably need a government or a municipality or whoever, I mean, somebody with the interest or the public interest to do something. You then need the dredging solutions to come up with solutions or proposals of what can be done, and then insurers can get involved to see what are the risks associated with the project and what I call the residual risk, i.e. if you build a coastal protection, never build that it goes up to, let's say, the 100% level. You always have a residual risk, and the residual risk is then the risk that can be insured. However, I also want to make another point, which is we also do forward-looking risk insights. So, for example, we have now these so-called RCP, representative consultation pathways, which basically have come up with different scenarios on how the Earth is warming up by 2100. So there's a 2.6 pathway, which says everything stays below 2 degrees warming. Then the 4.5 pathway, which is between 2 and 3 degrees. And the other one is the 8.5 pathway, which basically is the worst case scenario. So what Swiss Re, for instance, does is we do forward-looking risk modeling that give for a specific location, gives an idea, for instance, how sea levels are going to rise.
Yes.
And
So
I mean, these are very important insights, because you don't want to be today and then find out that in 10 years or 15 years or 20 years it's obsolete because you worked based on the wrong assumptions. So Swiss Re, I mean, insurers can not only provide the risk transfer solutions, but very often also risk insights, which then can flow into this project planning.
Okay, so Christian, in Mr. Kirkland's potential project, one of the things that you could provide is much more insight into the risks and therefore what would be reasonable choices. Paolo, who would you turn to in the field of investors or capital providers?
I think that Jack make a very good point. If you open possibly the largest well-known online magazine for PPP, which is called infrappworld.com, you will barely find any maritime project there. So the first thing is marketing, if I may, because I cannot tell you as a competitor of one of the large funds that are investing equity into these projects or will like to invest equity in these projects, I cannot tell you who is the best, because it depends on the market, depends on the jurisdiction, depends on the risk and so forth. What you have to do is to market your product. So you have to go and say, okay, there is a possibility to invest, I don't know, X million euro or dollars or yen or whatever into this project. First of all, get visible. I would say, which is not.
Yeah, Paolo, because that's not obvious.
Jack, I mean, this is. I never saw in my 20 years life in this branch. I never saw anything related to maritime coastal development or coastal protection. So this is the first, I would say.
Yeah, Paolo, sorry to interrupt you, but what do you read? Where should Jack market his project in order to attract your attention?
Just sending information to the journalists which are serving the financial world in the infrastructure space. There are 4 or 5 well-known magazines on the web. If your project is sufficiently interesting, or if you sponsor a little bit the web providers, or sorry, the web news provider, you will get attention, and you will get attention from the community of all the investment managers or the fund managers or so forth, or the banks as well.
Okay, so Paolo, let's do something concrete. Can you afterwards provide IADC with the names and references of these sources that you read, and we will make sure that they get published in the broadcast of this webinar, which will be available afterwards. So
I think that Ria should have it already, but for sure we can review it and then post it in the
excellent
on the web. Yeah.
Great.
So this is the first thing. The second one is clearly a little bit of market knowledge, which means you are working for possibly the largest organization which is supporting these projects, but for sure they will need private capital alongside their own investments requirements. They will need lenders or whatever. So possibly you should research who is the possible the riskier the provider of the risking, such as Christian, such as other people. To be honest, myself, we are not investing in the Pacific, but for European project we are ready to review anything. This depends on the fact that we are working with risk adverse companies, but in any case, there are different solutions and different. The world is very large, so you have to get in contact with them.
And so is the Pacific, and it's becoming bigger and bigger, unfortunately. We have a question from Reinhard. Thank you, Jack, for that question. We have a question from Reinhard Usma, who was one of the guests in our previous broadcast. Reinhard, can you come in?
Yes.
Hello.
Thanks. Am I in? I think I'm in.
Yep.
Thanks, Mike. Nice to see you, Jack. It's been a while, so I think it's time we need to catch up, because I think the Pacific is a little bit of one of my things where I think we can do big impact. The only thing I think which is a bit complicated, I think, in the Pacific is that if you look at coastal protection compared to number of people saved or that you're protecting and the value behind it is very complex because it's very shallow, very narrow land strips, which does not have a lot of value. And if you compare the investment you need to make on the side to protect it, it's very expensive. So I think we need to look at new models there. How to
What do you mean by new models now? What kind of new models? What kind of new?
Yeah, I think we need to look more at how we can maybe create land in a more efficient way in these islands. So and unfortunately, I think you would probably have to maybe relocate people, but you have to say, well, we cannot defend whole Tuvalu because Tuvalu, I don't know. I think maybe that's a project you're working on, Jack. I'm not sure, but.
Yeah. Okay.
If that's the case,
maybe I can give you a quick answer, Reinhard. Yes, it is in respect of the Tuvalu Coastal Adaptation Program. But this is basically the first step. There are still a lot of opportunities and possibilities to raise areas, to relocate certain infrastructure, to basically safeguard bigger areas for the future for the community. So
yeah,
let's
talk a bit more.
There's a bigger second phase.
Well, let's talk about this more
in detail separately.
Yeah,
maybe one comment I would like to make, I think, on what Jack is saying. I think financing these projects is because the business case is very difficult there, and I think the revenue streams, availability payments, these countries do not have a lot of money. But I think in the light of maybe COP27, which just I think made a way forward in the loss and damage discussion, where the loss and damage says, well, okay, we feel responsibility as a developed world. We want to create a fund, which is probably going to be happening in COP28. That could be a driver for, let's say, helping these SIDs, let's say, making their coastal protection, let's say, as a matter of, let's say, courtesy out of, let's say, the Western world has got some responsibility there to help them. That is, I think, the way the finance could work.
This could become a fund which could help creating easier bankability for projects which are now unattractive from the point of view of the revenue streams that they will produce.
If I may add something to what Reinhard said a few seconds ago. I think that the image I have in my mind after having seen the television reports on COP27 is what is happening in the Micronesia. So everybody connects the fact that we need to save the planet from overflowing islands or coasts around the world. So that means for me that the dredging or the maritime works based on sustainability solution or natural-based solution is possibly iconic to this problem. So it might be that you have a very good situation and drive because you are those that shows what is the real impact. So it might be that this is going to be quite important for your industry in order to support the development of these projects, which are really necessary, much more than a new railway in Africa, possibly.
Paolo or Christian, if you think about coastal protection and the opportunities that offers, what in your view is the kind of information from the world of dredging, from the engineering world, so to speak, that you think is currently missing in the world of finance?
I don't know, because for Christian it's different. It's possibly more easy to have direct access to projects. For us, very much depends on the marketing of these projects from the sponsor, on the sponsor side. So we do not receive this kind of projects. We had the chance and the luck to get in touch with the two associations, I mean ICDA and CEDA, but otherwise we would never have had the possibility to enter into this potential investment world. So it's a matter of that the two worlds are not discussing with each other. I mean, you possibly have a connection with reinsurers, you have a possibility a connection with development banks or multilaterals, but not with the private equity world, which is strange, also on our side.
So what you're actually saying is it's not even specific information, it's just knowing about the presence of projects.
Exactly.
Yeah. So there's a lot of work to do for dredging companies and their representatives in order to establish those links. Christian, you've been working with IADC for a bit now. You also come from the world of finance. Where do you see that the associations have already been slightly more successful, and where do you see here you really need to boost your efforts in order to make sure that the financial world knows that you have an attractive asset class?
We'll probably have three points there. I mean, first of all, I don't think we see too many projects. I mean, there was a wish to see actually more projects. The second point related to that a little bit, the scale or the replicability of various projects. I understand a lot is unique, so that, yeah, but in order to make an impact, especially in respect of coastal protection, I think it would be good if you have some cookie cutter models where you can then apply scale to it. And then the third element is probably more from an insurance point of view, from a risk point of view, is about new technologies or new ways to do it. I mean, I understand dredging is a very established process, so it's not a lot of probably innovation, and I hope I don't step on anybody's toes now if I say that, but I think from a risk point of view, it's probably
I'm afraid you
already established.
Yeah,
but I think
sorry, let me
speak.
Because now I want to just briefly interrupt you there, because of course we're talking about two different types of innovation. There's a lot of innovation in the technology and the techniques of how dredging is working, and what you're referring to, just to put that into perspective, Christian, is innovation doing things differently from traditional dredging, right? Yeah. So those would be the nature-based solutions. Am I correct?
Exactly. Have more projects that are more nature-based, more green, more whatever you call it, so sustainable. And I think these are the projects we actually would like to see more on our desks, and see how we can actually then help to bring them over the finishing line.
Yeah. Okay. So we've got a couple of minutes left in this webinar. Thank you, Reinhard, for your contribution and your question. And I'd like to give you the opportunity to follow up on that.
I will do that. Is there still room for one more question, maybe, Mike?
Yeah, go ahead.
Yes, I'm just wondering, this, I think it's more a question for Christian and the insurance industry. Let's say we create a lot of the times value by reducing the risk in a certain, let's say, country. Let's say, for instance, we had a project in Senegal where we protected 5 kilometers of coastline. And then, so we have reduced the risk profile for all these properties, but I think it is more, let's say, preventing disaster, like you said before. But the problem is these houses are not insured at all. So if there would be an insurance, I think you could monetize this value. But do you have any creative ways how we could maybe make this work in monetizing this risk, or let's say using this reduction of risk for financing a project? Have you got any ideas on that?
Just the short answer is probably no. And the long answer is probably we have to see whether who benefits and how you potentially can tap into those funds. I mean, if you have a commercial, let's say, site which buys insurance, and then the risk profile is improved, therefore the premium comes down, I mean, that has a tangible benefit. If, however, assets are uninsured, I mean, then per definition, I mean, you can't benefit from premium savings and things like that. It's a tough one. Yeah.
It's a tough one. Maybe zoom in a bit. If we would have a insurance company, so we have a power plant which is at the coastline, which is the risk, let's say worth 100 million, and they pay a certain premium. How do we get the reduction of the premium, which is paid in the end by the company, the owner, to you? but you are determining the premium. So you are in control of the height of the premium. We might be in control of, let's say, making the defense work, but the premium has to be paid by the other person. So how can we think up for a model to get that value into the coastal protection?
Yeah, I mean that's really the problem of this so-called externalities, where sometimes a third party benefits from a project that they didn't build. I mean, one could argue probably can steer it a little bit with regulations or taxes involved in that and redirect some of those funds. But I think, I mean, these are complex questions and probably not something an insurance company has a direct influence. It's more on the very often more on the political level, how you deal with this, with these things. I mean, for us, what is interesting is, okay, if the risks are reduced, then per definition, insurance premium should come down for future risk. But how do we allocate this cost savings to other parties? I mean, let's face it. I mean, we don't get the higher premium and then can redirect part of it to the project. I mean, we assume less risk, therefore the client pays less, and then if you want the incremental savings is it's not really part of the whole insurance equation.
Okay, but it would be, I mean, just think out loud now. It would be nice maybe if you could give some guarantee for 20 years, if we would reduce the risk for the property by let's say, maintaining a dike. If you can guarantee for the end payer that the premium would go down for X amount, then you might be able to monetize this. But then you need to give this guarantee that based on our measure, your risk profile is reduced. That is maybe where we can find something. But
may
it's
I?
not an easy one.
May I? Stupid ideas, but if you involve the main stakeholders benefiting from the dike, in this case, that means the power plant companies is a sponsor and shareholder of the PPP vehicle or the SPV that would pay then you might have the SPV, so the power, the project company, accumulating the benefit of the insurance reduction by being the let's say the insured party, and then reselling to the power plant the benefits, or keeping the benefits for the shareholder. So this is ways where you might find ways to bring this kind of discussion in. It is clear that if there is a main stakeholder benefiting from the and this as let's say a sufficient large capital structure or capital base, then it might be that he is the right one sponsoring the project or being the first investing in the project as an equity provider.
Gentlemen, in the interest of time, I need to now put an end, unfortunately, to this fascinating discussion. What it points to, though, is that the road ahead towards obtaining more funding for more sustainable projects is fraught with a lot of difficulties, which particularly relate to making the cash flows in somehow or some way or other clear, and pinpointing what beneficiaries would be necessary in order to talk together and then find better solutions. That's at least what I got from this final discussion. Before we close off, each of you, in literally 10 or 15 seconds, what would be your main advice for dredging companies who took part in today's webinar? Paolo, could you go first?
I think that, as I said, the possibility to get informed about what is required from the industry or from the public institution procuring the projects is for us quite relevant. We do not have visibility, and this is for us very, very important.
Thank you. For you, Christian?
I think on one side to get earlier involved in those projects, and then probably a personal wish that we see more nature-based solutions or greener projects, which we then can support. Projects have a positive impact on nature, biodiversity, you name it.
Yeah. Thank you, gentlemen. Thank you for being with us today. Ladies and gentlemen, as I said at the start of this webinar, we are going to continue this discussion, in fact, more intensely and with a lot of those stakeholders at the table on the 9th of February in Dubai. Again, organized by IADC, B Capital Partners is involved, Swiss Re is involved. We're going to involve the local authorities in order to try to broaden the discussion as much as possible to pinpoint the obstacles which are now preventing these two tracks from getting together, and as much as possible try to work out solutions. We would hope to welcome you there on the 9th of February on behalf of IADC. Thank you for your presence today, and have a pleasant continuation of your day. Goodbye.